Hello, very good morning to all. I'm Kelvin here again, and welcome to a brand new daily dose of market insights by OANDA. Very good morning. Today will be Tuesday, the 3rd of December 2024, and how fast time has fly. We now come to the last month of 2024. So before we start today's gist of daily dose of market insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, before we jump into the intraday technical outlook on the various broad-based cross-asset classes, let's have a recap what has taken shape yesterday in terms of economic data release, key news flow, and its respective impact on the various broad-based cross-asset classes on an intraday basis. So let's start with the US stock market. So yesterday we see the return of a full US trading session in the US stock market, where we continue to see a positive follow through, I would say, on the mega cap centric US stock indices. So we see a rotation. So on an intraday basis, yesterday we see an outperformance of the mega cap technology stocks that benefited the SPX and the Nasdaq 100. Both of them actually outperformed the Trump trade narrative sensitive Dow Jones Industrial Average and the Russell 2000. So the SPX is up by 0.24%, the Nasdaq is up by 1.12%, and the Dow Jones and the Russell 2000 did a corrective pullback of negative 0.3%, and the Russell 2000 negative 0.02%, almost unchanged. So I would say it's still a kind of a healthy bullish rotation among the major US stock indices on the intraday basis. So if you look at the perspective of the heat map of the S&P 500, very clearly yesterday's strong stellar gains has been centered around the mega cap technology stocks, which is Microsoft is up by 1.78%, Apple up by 0.95%, followed by Google and Meta both by 1.4%, at positive 3.22%, Amazon 1.36%. The smallest among them, among the mega cap technology, mega cap stocks, I would say, is Tesla, continues to be positive 3.5%, in line with Elon Musk having a much more vocal and we call it influence in the upcoming Trump administration. And one also positive news flow that is supporting this bullish upbeat mood in the major US stock indices yesterday has been preliminary, we call it Black Friday sales figure. So based on a, we call it a Adobe, yes, I think, where was it? Yes, so according to MasterCard spending pulse, so it's just a kind of a tracking by MasterCard. So Black Friday sales actually grew at a faster pace in US this year. So indicating there is still some signs of a Goldilocks scenario in the US economy. Market right now is also been focusing more on the Trump trade narrative that is positive side of the story. That means a deregulation and steeper corporate tax cuts, away from the negative aspect of higher tariff trades against the rest of the world. So, and as well as yesterday's key economic data on the ISM manufacturing PMI also supported this bullish upbeat mood in the US stock market, where ISM manufacturing PMI grew slightly faster, or I would say that contract at a lower pace, the correct word to use, because it's still below 50, 48.4 for the month of November, above 46.5 that was recorded in the previous month of October, and surpassed expectation of 47.5. And the subcomponent of it, which is the manufacturing employment subcomponent, also grew or slowed down at a slower pace, 48.1, above 44.4 that was recorded in October. So net overall is signaling a kind of a Goldilocks scenario in the US economy right now, and also coupled with more or less kind of a high odds that the US Federal Reserve is online to actually reduce its interest rate cut on the Fed funds rate before 2024 ends by looking at the CME Fed Watch 2. So market participant now is assigning a high probability of 75% based on the traders in the Fed funds futures market compiled by the CME Fed Watch 2. So bringing the Federal Reserve Fed funds rate to 4.25% to 4.5% in the next 2 weeks on the 18th of December FOMC meeting. And what's important over here is that this odds has been steadily increased since a week ago, which was at around 50% coin toast at 52.3%. And what's interesting over here is on the 18th of December 2024 FOMC meeting, the US Federal Reserve also released their latest dot plot. So this later dot plot will consist of a median projected forecast among the US Federal Reserve officials in terms of economic metrics, key economic metrics of the US, like unemployment rate, economic GDP growth, and inflation rate, and most important, where will the Fed funds rate will be in 2025. So based on market assigned probability in according to the traders in the Fed funds futures market has been assigning a rather shallower dispersed interest rate cut cycle for 2025. That means looking at only two possible interest rate cut that is being spaced out in 2025, coming in July next year, which assigned at 82% probability to bring it down to 4% to 4.25%. Then thereafter, a series of stampede, and the next potential interest rate cut will only come in on the 17th of September 2025 meeting, which is at 83% chance. And if you recall the previous dot plot that is being penciled in by the US Federal Reserve in the September meeting, what they project over here is that in the median projection for the Fed funds rate to be at 3.4% in 2025 and in 2026 to be at 2.9%. So if you're looking at 3.4% over here, it's rather aggressive previously, because that actually implied between 3 to 4 interest rate cut for 2025 for 25 basis point each in the previous dot plot projection for September. And given that market participants has now adjust this slight dovish tilt to only assign by space out two interest rate cut projected of 25 basis point each in 2025. So market participants will be definitely pay a close attention of whether the Fed will adhere to this current market projection, which tends to be much more in the past, much more dovish than what the Fed has projected. So given the fact that whatever Trump's fiscal policy and trade tariff threats that could be installed once he's in office on the 20th of January next year, very likely US Federal Reserve got to temper their dot plot projection again. So market participants will be paying very close attention on the 18th of December latest release of the median Fed funds projection for 2025 and even the longer term 2026. But for now, this Goldilocks scenario in the US economy, coupled with more or less high chance of another interest rate cut in the December meeting, that actually fueled optimism in the major US stock indices, and also strengthened by this US dollar strength against the rest of the world, that is also supporting US stocks against the rest of the world as well. So I call it US stock market outperformance against the rest of the world. So if you look at the US dollar major against the major currency, US dollar against the major currency as of 5-day rolling performance as we're speaking right now. So this is more of a short-term performance of the dollar against the rest of the world. Very clearly, the dollar is strengthening against currency that potentially could be impacted by higher Trump trade threats or tariffs in 2025. Dollar dollar is strengthening the most against the Chinese yuan, which is up by 0.72%. And solely closing behind will be the Swiss franc, up 0.22%, dollar Aussie as well, dollar Sing, because dollar Sing also has a very close proxy with the dollar CNH, which is also showing signs of dollar outperformance, followed by dollar CAD as well, because Canada is also being targeted. Europe is because of its own political turmoil in the France economy, where the far right leader Le Pen threatened to actually topple the current incumbent French PM by invoking a no confidence vote this week. Right, so that also create a bit of political unrest in the France economy, and we know that the France is one of the anchor eurozone economy, and that could potentially increase credit risk in eurozone, which actually indirectly create a negative feedback loop on the euro currency, where the dollar actually benefited from this fiasco. And what's interesting over here is the dollar yen. So dollar yen, yesterday I do mention that yes, we see a bit of mean reversion rebound on the dollar against the ongoing potential yen strength, due to fundamental reasons that this dollar strength may not be so pronounced in the Japanese yen. Two reasons that potentially could impact it is due to yen itself being used as a safe haven currency play or macro play in this potential trade tariff threats that's coming up from the US next year, where potentially we could start to see yen strengthening in those yen crosses across the board over here. So what do I mean by this? Is by looking at this particular chart itself, where I plotted the 1 month rolling performance of the G10 yen crosses. All right, over here as of now we are speaking. So we see a very clear downtrend from a medium term multi-week perspective. What is a 1 month rolling performance since the peak of 15th of November. All right, so since 15th of November, the Japanese yen has been strengthening against the dollar. That means if this slope is sloping down, that means the yen is the variable currency. So we see dollar yen inching downwards. The Norwegian yen, the CAD yen, the Kiwi yen, the Aussie yen, the Swiss yen, the sterling yen, the SEK yen, and even the Euro yen, which is the worst performing currency right now. Cross pair, I would say, worst performing yen cross pair due to its inherent political instability in one of its anchor economy, which is France over here. And this is also being supported by the 2-year Treasury yield spread premium over the 2-year JGB yield has started to narrow as well, right? Supporting this ongoing medium-term yen strength. And this yen strength has also been supported from this is a medium-term basis on a hawkish rhetoric that is being spewed out from the boss himself, BOJ Governor Yuda. So yesterday he mentioned in a Nikkei interview, which is the local international Japanese newswire interview, that right now over here that interest rate hikes are nearing. Okay, he mentioned this word. The keyword is nearing over here, giving a bit of head starts that December, the upcoming December meeting in BOJ, which is due to about 2.5 weeks time, is being live right now. So there's a possibility that there could be another 25 basis point hike coming up from Japan. So in line supporting medium term multi-week dollar yen weakness. Yes, on a shorter term, there still be a play of this mean reversion rebound that could take shape on the dollar yen towards around the 151 level, which is a mean reversion back to retest the downward sloping 20-day moving average. So later I'll touch more about that when I cover the short-term intraday technical outlook on the FX market. All right, so other news flow over here to highlight over here is there's this still ongoing US tech war that is still on the still at play, and that could actually worsen next year given Trump trade tariffs. So the current Biden administration vote to actually tighten curbs on China access to AI memory and chip tools. Right. So that also saw the lackluster movement on the Hang Seng indices over here. So the Hang Seng indices being as an international proxy for China's stock market play is down by 0.25%, and the more sensitive tech proxy, which is the Hang Seng Tech Index, is down negative 0.8% as we are speaking. And even the local China mainland market, the A shares barometer, which is the CSI 300, is down negative 0.3%. So given this ongoing US-China trade war and likely will to be accelerated in the upcoming Trump administration, that also doesn't gel well for the sentiment for the China benchmark stock indices, and as well its proxy, which is the Hang Seng indices. All right, so that sum up the the news flow, the economic data that was released yesterday, and their impact on the various movement on the broad-based cross asset classes on the intraday performance yesterday. So today there's no intermarket dynamics now interesting that I will share with you all, but I will focus now straight to the intraday technical outlook on the broad-based cross asset classes, starting with the FX market. So as usual, let me expand my screen so that you all have a better view on the key levels and the trends that I would want to cover for you guys. All right. Right, good, cool. So let us start with the euro dollar first. All right, over here. So on the euro dollar, price action continues to be bearish as it broke below the bearish flag that we highlighted earlier on last Monday, indicating that whatever rebound was a mean reversion rebound within its impulsive downward sequence that is still playing out on the euro dollar. So price action continues to shape lower low. Over here, first resistance zone to watch out for today will be at 1.052/1.054, this area here, but I do not want to title it as my short-term pivotal resistance level just in case of any whipsaw. So I'll be still using 1.0610 as my short-term pivotal resistance, which also confluence with the pullback line of this former bearish flag ascending support now turns into a pullback resistance that confluence with the downward sloping 20-day moving average as well, which is in red over here. So as long as any bounce for today that remains below 1.0610 short-term pivotal resistance level on the euro dollar, we will still maintain the intraday bearish bias for the continuation of the resumption of this impulsive downward sequence to revisit 1.0410. Below it exposes the swing low area of, or the swing low of 22nd of November at 1.0330 in the first step. Only a push up and an hourly close above 1.0610 short-term pivotal resistance will invalidate today's intraday bearish bias to see the continuation of the mean reversion rebound, exposing the next intermediate resistance zone to watch out for will be at 1.0660/1.0680. Above it sees 1.0770, which confluence with the downward sloping 50-day moving average that is soon to be acting as a resistance level at 1.0770 as well. Turning our attention will be its cousin, the sterling dollar. So the sterling dollar continues to plummet and hit our first support zone before staging a minor bounce, which is the minor ascending trend line that is in place since 22nd of November minor swing low at 1.2610, 1.2580. Price action on the RSI doesn't show any signs of a bullish divergence, so indicating no clear signs of a bearish exhaustion in this yesterday's down move. So I will still be using so first resistance level to watch out for will be 1.2710 over here. Still using last Friday swing high area at 1.2750 because it didn't break down below 1.2580 to prevent any vicious whipsaw that could take shape because of it hasn't broke below 1.2580. I'll be still using 1.2750 as my short-term pivotal resistance level, maintaining that bearish bias on the sterling dollar. A breakdown below 1.2580 would reinforce or increase the probability of the resurgence of this impulsive downward sequence on the sterling dollar, exposing 1.2460/1.2440 next. However, if a price action managed to surpass with an hourly close above 1.2750, today's intraday bearish bias will be invalidated to see another leg of a mean reversion rebound extending towards the next intermediate resistance at 1.2840. Above it sees 1.2960, which corresponds closely with the downward sloping 50-day moving average. So that sum up the intraday technical outlook on the key European currency against the dollar. Now turning our focus right now will be on the Asia Pacific currency against the dollar, starting with the dollar yen first. So dollar yen, still recall yesterday we do have a key pivotal support level to watch, which is 14930/14885. Price action indeed tested the upper boundary of the short-term pivotal support, which is also the lower limit of this ongoing descending channel, minor descending channel that is still in place since the high of 20th of November. Yesterday, price action on the hourly RSI shaped another bullish divergence price action see lower low, hourly RSI shape a higher low. So indicating that this ongoing mean reversion rebound still is in play. First resistance to watch will be at the 150.60 for today. Only above 150.60 exposes the next intermediate resistance level at 15190/15215, which correspond to the 200-day moving average, and as well as the lower limit, upper limit, pardon me, of this minor descending channel. And around this region here, potentially there could be signs of bearish reversal candlestick forming, because the longer term picture on the dollar yen chart still looks bearish in the medium term basics on the daily chart, on the daily RSI, where our daily RSI has particularly broken down below a key parallel ascending trend line, below the 50 level mark right now, and still has room to go before hitting the oversold region. So indicating that from a multi-week perspective, the dollar yen could still see further weakness, supported by fundamental factors that I highlighted earlier at my start of today's daily dose. Right, so it's only on a intraday basis. We know that price action don't go vertical down, they move in oscillation or in cycles. This potential cycle that is playing out right now on the very intraday basis cycle, as long as 14930/14885 holds on the short, which is my short-term pivotal support on the dollar yen, potentially there could be still a intraday mean reversion rebound scenario playing out. Two key resistance level to watch out for: 150.60, above it 15190, 15215. Only a direct push down and a breakthrough below 14885 will invalidate today's intraday bullish bias for the mean reversion rebound scenario to get invalidated, to kickstart another round of impulsive downward sequence, exposing the next near-term support in the first step at 14725, which is this minor congestion area here of 3rd of October and 8th of October this year. Okay, so that's for the dollar yen. Now, turning our focus now will be the Australia dollar, the Aussie dollar. So the Aussie dollar, oops, where was is the Aussie dollar? Okay, here is the Aussie dollar. Yeah. So the Aussie dollar continues to shape that bearish breakdown yesterday below the minor ascending trend line that was formally in place since last Tuesday, minor swing low of 26th of November. Now turns into a pullback resistance at 64.93 over here. All right. So using 64.93 as my first resistance level, but still I don't want to tie it so tightly. 64.45, which is the minor swing high that got rejected on 20th of November and 25th of November, still acting as my key short-term pivotal resistance, to also very closely slightly above the downward sloping 20-day moving average. As long as 65, pardon me, 65, 45 short-term pivotal resistance still holds to prevent any rebound from surpassing above it, we will still maintain that intraday bearish bias on the Aussie dollar. First support level to watch will be 64.10. A breakdown below it exposes 63.60, which is the lower limit of a major support zone on the Aussie dollar. Why do I say that? If you go back to the daily chart of the Aussie dollar, this 63.60 over here is the lower limit, which is the swing low of 9th of November, 19th of April, and 5th of August, that has been tested 3 times and survived the bearish onslaught previously, and also correspond very closely to the major ascending trend line from the 13th of October 2023 low. All right. However, if the Aussie dollar, instead of failure to make any further potential downside pressure, and it start to surpass above 65.45, today's intraday bearish bias will be invalidated to see another leg of mean reversion rebound scenario unfolding, exposing the next intermediate resistance level at 66 figure and even 66.40 next, which correspond to the 200-day moving average and the downward sloping 50-day moving average. All right, so that sum up the intraday technical outlook on the major FX dollar pair. Now, turning our attention right now will be the major stock indices, starting with the Asia Pacific indices, which is the Hong Kong 33. So the Hong Kong 33 continues to trap inside this sideways range, still can't break above the downward sloping 20-day moving average. The hourly RSI continues to flash out a series of lower high, as you see over here, so indicating a lack of upside momentum as well. So still no change using 19,880 as my short-term pivotal resistance level. Still maintain that intraday bearish bias within this very we call it minor range configuration, and the minor range configuration lower limit or support level will be at 19,300/19,080. Only a clear breakdown below 19,080 that has helped the minor swing lows since last week will expose a much more pronounced down leg scenario on the Hong Kong 33 to see the next support level coming in at 18,740 on the intraday basis over here. So 18,740, just a recap, is actually this minor swing high, former minor swing high of 4th of June. However, if price action starts to shape a breakout above 19,880, today's intraday bearish bias will be invalidated to see a squeeze up towards the next intermediate resistance level at 20,150 and even 20,490 next. So that's for the Hong Kong 33. Now, very interestingly, on the Japan 225, so the Japan 225, instead of shaping that push down as intended towards the lower limit of that complex sideways range configuration that is in place, or that is still in place since 7th of September this year, it staged a bullish breakout above the 3 moving average, the 20-day, the 50-day, and the 200-day moving average, and as well as this former descending trend line that I drew from the high of 6th of November high. Over here, price action starts to accelerate on the upside and appears to be on mode to hit the upper limit of this complex range configuration over here. So with that, it already surpassed this resistance here, now turns into a pullback support level. All right, so I'll be using this region here. Let me clear this. Okay, the region of the 20 and the 20 and the 200-day moving average that is acting as a pullback support at 38,670. Okay, let me highlight it. 670. So 38,670 will be my short-term pivotal support level for today, as long as any pullback didn't surpass below 38,670, given that there could be a chance of a pullback taking shape right now, as the RSI is already coming close to a extreme overbought level that was previously seen over here on 25th of November, right? This red line over here, okay? Flip to a intraday bullish bias. Next resistance level to watch, 39,550, and above it we'll see is 40,155/280, which is the upper limit of this complex range configuration. Only a price action breakdown with hourly close below 38,670 will invalidate that minor bullish breakout within this complex range configuration to see it reintegrating down below towards the lower limit of this sideways complex range configuration. Next support level to watch out for will be this level here, the minor swing low of last Friday that was being supported on yesterday Asia session at 37,990/37,765, the previous support level of 15th of November. All right, so that's for the Japan 225, flipping to a intraday bullish bias within its sideways range configuration that is still at play. Now, turning our attention will be the German 30. So the German 30 ironically continues to rally up in hopes of much more deeper rate cuts by ECB to address this inherent economic weakness in the Eurozone and potentially political instability that could also create further weakness in the Eurozone next year due to this ongoing political fiasco in the French Parliament right now, as I highlighted earlier for you guys in today's daily dose. So with that, price action going to trade higher, surpass the resistance level that I highlighted yesterday, which is defined by FIBO extension cluster level 19,840/19,020. So this level here will be a pullback support level to watch at 19,830 for today. Price action on the hourly RSI continues to see it flipping up to a extreme overbought level. All right, so I think it's an overbought level that is more than 4 weeks. Yeah, it's a 4-week high, right? But this extreme overbought level doesn't come with a bearish divergence. All right, price action continues to trade higher, right? That is in line with the price action that was being seen on the German 30 yesterday. So with that, there could be a chance of a potential pullback, given that it's an extreme overbought level. As long as this pullback didn't surpass below this Titan short-term pivotal support level that I have for today at 19,690, okay, which is this former minor swing high area of 29th of November, and as well as the Fibo retracement of this short push up, which is close to the 38.2% Fibo retracement level. All right, so as long as this pullback didn't surpass below tighten short-term pivotal support level for today at 19,690, we'll still maintain that intraday bullish bias on the German 30. Next resistance level to watch on the upside, 20,010, followed by 20,155, which is the 1.618 Fibo extension. However, if price action starts to surpass below 19,690, that would negate today's bullish bias to see the much more pronounced corrective pullback scenario unfolding for the German 30 to potentially revisit the former breakout area, now turns into a pullback zone at 19,550/19,450 level. All right, so still maintaining that intraday bullish bias with a tightened short-term pivotal support level at 19,690 for the German 30. Now, turning our attention will be the major US stock indices, starting with the US Wall Street 30. US Wall Street 30 yesterday did an attempt to try to break above 45,070, which is our first resistance before pulling back and start to trade sideways, but holding above our first support level at 44,730. So still using 45,520, which is much more clear as a key short-term pivotal support. Why? Because former minor swing high, tested one time, tested twice before shaping the fresh all-time high last week. So still using 44,520 short-term pivotal support, maintaining that intraday bullish bias on the US Wall Street 30 above 45,070 sees 45,450 next, which coming close to this dark turquoise green channel line here, which is the upper boundary of the major ascending channel that is still in place since March 2020 low. Only a price action breakdown of hourly close below 44,520 will invalidate today's intraday bullish bias on the US Wall Street 30 to trigger a intraday mean reversion decline scenario to revisit 43,980/43,807, which correspond to the rising 20-day moving average. Right, so now turning our attention lastly will be the Nasdaq 100. So the Nasdaq 100 yesterday managed to burst up. So yesterday we flipped to a bullish bias because of the inherent short-term technical element has started to turn more positive. So it staged that breakout above 20,990. So this level here will be turns into a pullback resistance. All right, it almost hit the current all-time high at 21,220, with the hourly RSI now coming close to a extreme overbought level as well. Right, but no bullish divergence. So indicating there could be some form of minor pullback taking shape. So as long as this minor pullback didn't surpass below 20,970/880, which is confluence with the rising 20-day moving average, we will still maintain that intraday bullish bias on the Nasdaq 100. Next resistance level to watch after 21,220 will be 21,380 slash 21,500, which is being defined by a Fibo extension cluster level. Okay, let me put it in writing. 21,380, 21,500. Right, only a price action breakdown below 20,970/20,880 short-term pivotal support level that would invalidate today's intraday bullish bias to see another choppy corrective scenario unfolding on the Nasdaq 100, potentially exposing the minor swing low of last Thursday at 20,680. Below it sees 20,490, which is the minor swing low of 21st of November and corresponding to the rising 50-day moving average as well. So that sum up the intraday technical outlook on the major stock indices. Now, turning our attention will be the commodities market, starting with gold XAU/USD. So I did mention that gold XAU/USD is still showing signs of a lackluster bullish momentum movement as price action continues to trade sideways with this downward sloping 20-day moving average and can't break above the 50-day moving average that was resisted on last Friday, which is our 2,660, 2,666 short-term pivotal support level. So pivotal resistance level, pardon me, not support level, is pivotal resistance level. So price action yesterday shaped a push down, almost tested the minor swing low of last Thursday before shaping a minor bounce. All right, so still no change, still using 2,660/2,066 short-term pivotal resistance level, maintaining that intraday bearish bias. So two short-term intraday support level to watch for today will be 2,622, which is yesterday minor swing low, a breakdown below it exposes 2,600/2,590. So only a breakdown below 2,590 will potentially unleash a much more meaningful corrective decline sequence within its major uptrend phase that is still intact, exposing the next support zone of 2,546/2,526. Only an hourly close above 2,666 will invalidate today's intraday bearish bias on gold XAU/USD to see a minor recovery towards 2,689, followed by 2,728/2,715 next. Lastly will be the West Texas crude oil. So West Texas crude oil continues to sluggish as we await for OPEC Plus meeting, which is on the 5th of December, 2 days from now. It continues to trade a series of higher low below a downward sloping 20-day moving average. So using the 20-day moving average right now and also confluence with last Friday minus swing high, 60.80 will be my Titan short-term pivotal resistance on West Texas crude oil, maintaining that bearish bias with two key support level to watch will be 67.55/10 followed by 65.70. So 65.70 is the lower boundary of a major support zone. Why is it so? Because it's the lower limit of this ongoing descending major triangle range configuration that is still in place since the low of 20th of March 2023. Only hourly close today above 60.80 will negate today's bearish tone to potentially see a squeeze up to revisit 70.80, which correspond to the 50-day moving average. Right now above 70.80, see 71.80 and even 73.15. That was the previous key minor range resistance where price action has failed to break above it since 24th of October. Okay, so that also sum up the intraday technical outlook on the broad-based cross asset classes. So let's take a look at the economic calendar for today. What are the key events to look out for that could impact these broad-based cross asset classes intraday movement? So today will be Tuesday. So on Tuesday over here during the European session, we do have, okay, give me a minute. Yeah, there's ECB official speaking, ECB Cipollone speech at 4 p.m. Singapore time. And we do have a second tier labor market report in the US. They call it the jobs opening, but definitely the most important one will be this Friday NFP data. So we touch more about that on as we head towards on Thursday and Friday. So second tier labor market data for US, they call it the JOLTS jobs opening at 11 p.m. Singapore time. All right. Then thereafter, during the US session, which is mid-US session, also then early Asia session, we have two Federal Reserve officials speaking, Fed Kugler and Fed Gospi speaking at 1:35 a.m. and 4:45 a.m. respectively. All right. Then and at 8:30 a.m. Singapore time tomorrow, we do have third quarter GDP growth rate out from Australia that could potentially impact the Aussie dollar cross pair. All right, so that sum up the daily dose of market insights for today. But before we go, do let me share with you guys, there's this ongoing fly to New York lucky draw event that we're having right now for existing clientele. So to find out more details of how to take part this lucky draw, so this last day of this lucky draw, we call it running date, will be on the 31st of December 2024, and the draw will be drawn out in the date on day dose on the 10th of on the 13th of January, okay, or 10th of January next year, pardon me, it's a Friday, okay, 10th of January next year, 2025. So to find out more details, do scan the QR code over here. So I'll leave this slide on for a couple of seconds. So with that, do have a great day ahead, and we shall speak again tomorrow. Thank you.